In the 2008 crisis, almost every big bank CEO lost their job. Some went down during the crash, others in the aftermath. But Jamie Dimon is different. He was the CEO of JP Morgan Chase before the crisis, and he is still the CEO today. He not only saved JP Morgan, but he even saved Bear Stearns at the request of the US government. And yet, after he did what the government asked, the same US government backstabbed him. How he feels today about that betrayal by the US government and how he outsmarted everyone, all of this we will uncover in this video. Jamie Dimon's rise started long before he joined JP Morgan. Before, he worked under Sandy Weil at Citigroup, and for years he was Weil's partner in building a giant bank. But Dimon was not someone who simply agreed with his boss. He asked blunt questions, pressed for clear numbers, and pushed back when plans seemed risky. That bluntness created tension, and in 1998 the relationship broke down and Dimon was forced out from Citigroup. After helping build Citigroup, he suddenly found himself out. It was a humiliating moment, but it forced him to rethink how he wanted to run a bank. In 2000, he took the job as CEO of Bank One. It was a regional bank in Chicago that was in trouble. The bank had weak controls, sloppy lending practices, and a culture used to perks. Dimon started with visible and practical fixes. First, he canceled private jets for executives, tightened travel budgets, and made managers justify every expense. He reorganized risk and finance teams and demanded better documentation on loans. He also did something simple and personal. He walked into branches unannounced to see how loans were actually approved. He would open a loan file and ask why a loan was approved. In one such visit, when he found incomplete paperwork, he corrected the process immediately and insisted on better checks. Those inspections from Dimon were not for show. They sent a clear message that shortcuts and sloppy work would not be tolerated. He often replaced managers who tolerated sloppy work and put people in charge who understood lending and controls. He invested in operations and faster loan processing, clearer audit trails, and stricter approval rules. He tied bonuses to long-term loan performance, not one-off fees. All these changes were boring, but they built a foundation. In a few years, Bank One's results improved, and once Bank One bounced back from almost collapsing, JP Morgan acquired it. That deal put Dimon in a top role at JP Morgan Chase, and within a year, he became CEO of JP Morgan. One thing Dimon is famous for is the Fortress balance sheet. It sounds like a slogan, but it is very practical. He wants the bank to hold extra capital, keep ample liquidity, and enforce strict risk limits. In a banking industry that praises leverage and fast growth, this plan looked cautious.
The Fortress balance sheet is that you run a company serving clients well, you have good margins, good liquidity, good capital. I'm as conservative an accountant as you can find. I don't upfront profits when I can spread them over time. And if I make bad loans, they are bad revenues. They will kill you, but for a while they look pretty good. So in the banking business, the character of the clients you have will reflect on your bank. So the first thing is, who are you doing business with? How are you doing business? And
Dimon believed missing some profits was better than risking the whole bank. That view shaped many of his decisions leading up to 2008. By 2006, the housing market was booming. Banks were bundling mortgages, including risky subprime loans, into securities and selling them worldwide. These products looked safe because rating agencies gave them high ratings. In 2006, during a meeting, executives showed Dimon charts of rising mortgage returns. Dimon listened and then asked a very simple question: do you really understand what's in all these mortgage-backed securities? What happens if housing prices fall by 20%? The room went totally quiet, and no one in his team had a clear answer and no plan if something like that happened. That question changed JP Morgan's posture. He ordered teams to cut exposure to the riskiest mortgage products and demanded better documentation. He asked to run harsh stress tests and instructed his team to stop chasing growth in areas they didn't fully understand. His caution helped because when the housing market collapsed in 2007 and 2008, JP Morgan's losses were real but far smaller than its rivals. Dimon also made sure JP Morgan kept its leverage lower than competitors. Lehman Brothers was leveraged more than 30 to 1, meaning for every dollar it had, it borrowed more than $30 to invest. That worked as long as markets kept rising, but when asset prices fell, the leverage turned deadly. JP Morgan, under Dimon's discipline, was closer to 12 or 14 to 1. This was still risky, but far safer compared to the rest of Wall Street. Lower leverage meant JP Morgan could absorb shocks without collapsing. Another thing Dimon did was maintain tighter credit standards. Many banks at the time were handing out mortgages with little documentation, known as no-doc or liar loans. These were loans where borrowers could claim income without proof, and banks still approved them. JP Morgan didn't avoid risky mortgages entirely, but Dimon constantly pressed his teams to keep standards higher than the rest of the industry. That decision kept JP Morgan from drowning in bad loans when the housing bubble burst. His attention to detail also made a difference. Dimon was known for sitting through risk reports and asking direct, sometimes uncomfortable questions. Unlike many CEOs who left the numbers to their subordinates, Dimon wanted to see the data himself. He often used to call out executives during meetings if their numbers didn't add up. He was relentless, and while many found him tough to work for, that culture of accountability forced people to be careful with risk. Dimon also had a rule about complexity. If you could not explain a product in plain English, you should not trade it. Derivatives like credit default swaps were widespread and often misunderstood. Dimon did not ban these trades, but he demanded clear explanations, tighter collateral rules, and firm limits on exposure. Traders who wanted large bets had to show worst-case scenarios and how those losses would be handled. That discipline limited the chance the bank would be blindsided by losses across markets. Another part of his approach was culture. Dimon insisted that bad news travels faster than good news. In meetings, he cut through glossy slides and asked tough follow-ups until the numbers made sense. He scribbled his own calculations and cross-examined teams until they admitted the downside. People found him harsh, but that culture made it harder to hide problems. Risk teams were empowered to stop deals that looked dangerous, and managers learned to prepare honest answers. By the time the crisis exploded in 2008, Dimon's cautious approach had positioned JP Morgan not only to survive, but also to act as a stabilizer in the system. In 2008, when Bear Stearns was about to fail, it was losing the confidence of markets. If it would have failed outright, it could have triggered a domino effect across Wall Street. At the time, the US government begged Dimon to step in and buy Bear Stearns to stop panic. To convince him, the Fed promised protections. It would take on $30 billion of Bear's worst assets, so JP Morgan wouldn't get stuck with all the toxic junk. Dimon and a small team worked around the clock on Bear Stearns. They pulled loan tapes, called counterparties, and demanded fresh valuations. They worked hard to map Bear Stearns' exposure. At one point, early Sunday, a junior analyst flagged a block of mortgage securities that had unusual collateral layers. Dimon pushed his team to dig deeper. They called counterparties to confirm positions and negotiated terms with the Fed to limit immediate losses. The initial price they offered was $2 a share. It was later raised to $10. Dimon agreed reluctantly, though he didn't want to do the deal, but he saw it as his duty to stabilize the system. At the time, the government and media hailed JP Morgan and Dimon as heroes for stepping up when no one else would. Later that year, Washington Mutual, the largest bank failure in U.S. history, also ended up in Dimon's hands. JP Morgan bought Washington Mutual's assets after regulators seized it. These acquisitions were risky, but they showed how Dimon used the crisis to strengthen JP Morgan's position. While other banks were collapsing or begging for bailouts, JP Morgan was expanding its empire. After the dust settled in 2013, the US government backstabbed Dimon because the Department of Justice and other regulators went after JP Morgan for mortgage-backed securities fraud tied to Bear Stearns' activities before 2008. In 2013, JP Morgan was hit with a record $13 billion settlement. A huge chunk of those billions of dollars was for bad mortgages and toxic securities created by Bear Stearns and Washington Mutual, not originally JP Morgan's own. Dimon's argument was simple. We saved Bear Stearns because you, the government, asked us to. And now you're punishing us for the sins we inherited when we bailed them out? Dimon said publicly that taking over Bear Stearns was the worst deal of my life, and he will never do something like that again. This does not mean JP Morgan was innocent. They also paid billions in fines for their role in selling bad mortgage securities. Dimon himself admitted the bank wasn't perfect. But compared to the disasters at Lehman, Citi, and Merrill, JP Morgan stood tall. Many people in Washington saw Dimon as the adult in the room when Wall Street seemed out of control. The result was that Dimon's reputation grew while others fell. Dick Fuld of Lehman Brothers became a symbol of failure. John Tain of Merrill Lynch lost his job after selling his bank to Bank of America. Lloyd Blankfein of Goldman eventually stepped down in 2018. But Jamie Dimon remained. His mix of caution, discipline, and opportunism made him the only CEO from 2008 still leading a major bank today. Even now, almost 2 decades later, Dimon's influence is unmatched. He's one of the most respected CEOs on Wall Street. JP Morgan is the largest bank in the United States and one of the most powerful financial institutions in the world. Politicians from both parties have sought his advice. He has been mentioned as a possible Treasury Secretary more than once. And every year, his annual shareholder letter is studied by investors, policymakers, and other CEOs for insights into the economy. What makes Jamie Dimon's story so striking is not just that he survived 2008, it is how he positioned himself before the storm. While others chased quick wins, he built a fortress. While others ignored risks, he asked hard questions. And while others fell, he stood tall and used the crisis to make his bank even stronger.